Hello, this is Dylan Moore with Irida TV coming to you today. It is Wednesday, March 9th, 2022, and today I've got Nima Majour, who is also from Irida TV. Nima, how's it going?
Pretty good.
Yeah, I'm doing excellent. I'm excited to talk about the thing that we got together to talk about, which is how to make some more money out of your money. So Nima is an advocate and a practitioner of what's called the permanent portfolio. And we wanted to do a show talking about this because we feel that it's going to be beneficial to anybody who listens to it. And particularly in the time that we're facing where inflation seems to be so run amok, it's important to have a tool at our disposal because your bank account sure isn't doing it at 0.25% or whatever the heck it is. A tool at your disposal to give you a return that at the very least can get you neck to neck with inflation and hopefully beyond that. So, Nima, can you start off by giving us a 30,000-foot view on what is the permanent portfolio and how'd you find it?
Mm-hmm. Yeah, the permanent portfolio is an investment portfolio that was created by Harry Browne, who was an investment advisor, radio talk show host, and also, I believe, one-time Libertarian Party presidential candidate in 2004 or so. And I invest my money, my core holdings that way. And I think it's a great portfolio for many reasons that we're going to be going through today. But just a big picture view is it's basically a very simple portfolio that's divided into 4 asset classes, 25% each, cash, gold, stocks, and bonds. Okay. The permanent portfolio will help you understand, if you understand the permanent portfolio and what drives it, it gives you a perfect or bird's eye view of the entire macroeconomy and which macroeconomic factors affect which assets in the portfolio in what way. So I think we can just get started with,
we might as well just jump into the 4
mm-hmm. Yeah, the four
corners of the earth that you just brought up, or the 4 corners of the economy.
So the 4 assets, so like I said, 25% each and 15 and 35% rebalancing bands, which means that if any asset drops below 15% or grows above 35% of the overall asset portfolio, you rebalance the entire portfolio. You sell the leading assets and you buy the lagging assets to restore that 25% balance. So the first 25% is stocks, and specifically not one particular company stock or not a stock list that you
personally have. I like these stocks. We're not talking about those.
Exactly.
Yeah.
But it's rather you buy an index fund that represents all stocks in your country, cap weighted, which would mean in the case of the US, for example, you buy an index fund that represents the entire stock market. What I do is I buy the S&P total stock market index. It's a little better than the S&P 500 in my opinion, because it's more expansive. It includes more assets, and in particular, it includes more risk assets. So when the economy does well, when it's time for the stocks to be the main driving force of your portfolio, you want to have an asset that you want to have a stock asset allocation that's growth oriented and not conservative. Because the conservative for the conservative stuff, we have other sections of the portfolio.
Right. So the stock is like the aggressive of the 4.
Stock is the aggressive, and Harry Browne even at one point mentioned, I think in his book Fail-Safe Investing, which we'll link to as well, which is where he basically first introduced his portfolio. He says that you want to buy more volatile, growth-oriented funds, but actually the S&P total, S&P 500, due to the nature of the U.S. economy, which is largely tech and all that, is actually a great aggressive stock position already. So you don't really need to worry much. You don't need to think much about it. You don't need to be an expert to buy an S&P 500 total index fund. Right.
Yep.
So that's where the rebalancing comes into play. You know, if your stocks crash and the stock allocation, say, drops below 15%, and you have other assets outshining your stock allocation, then if you hit the rebalancing bands, then you get to buy stocks very cheaply.
When your other asset was worth more.
When your other assets were doing great. So that's another great thing that the portfolio does. It tends to force you to buy low and sell high. And it particularly does it at the moments when you instinctively or intuitively least feel like doing that thing.
That's an interesting point to point out. Like, oh, the stock market's bad, I don't want to touch it, when literally that's supposed to be the time that you're supposed to buy it. Yeah.
Exactly. And that's because the portfolio forces you to make counterintuitive decisions in these turbulent times. You know, when stocks crash, when gold is going up and up and up. Oh my God, I love my gold so much. And stocks, nobody wants stocks. They all suck. And that's exactly when the portfolio tells you to sell gold and buy stocks. And you can go back and listen to other people who invested using this portfolio. A lot of them talk about how they just absolutely hated rebalancing, but then at the end of the day, it always turned out to be a beneficial decision for them financially. In my case, I so far haven't had to rebalance yet. So, you know, I've had this portfolio since 2015.
You haven't rebalanced in 7 years?
Because I haven't hit the rebalancing bands.
Interesting.
That whole time. And that's another good thing, you know, because ideally you want to have as few of these rebalancing events as possible because of tax liabilities that come due when you realize capital gains. And, you know, so I haven't had to rebalance yet. I may have to one day, but it hasn't come to that yet.
Okay. Let's move on to the second asset.
Yeah. Second asset is treasury bonds. So, basically 25% goes to buying treasury bonds. And what that means is you buy the longest available government bonds in your country.
And by US, longest, you mean you want the 10-year note, not the 1-year note, for example.
Yeah, or in the US, I want the 30-year note, not the 10-year note or the 1-year note. No. So you buy 30-year treasuries and you sell and you renew them every 5 years or so. So you sell them off after 5 years and then you rebuy the latest, newest treasury bonds available. If they come up with 40-year bonds, you know, then I would reallocate. I would sell my 30s and buy 40-year, whatever the longest available government bond in your countries. I think Japan has 50-year bonds at this point, and I think they pay maybe 0.01% or so.
At least they're not negative. More. Yeah.
Yeah, right. Maybe more than that, but I'm just exaggerating. So when do treasury bonds do? Oh, first of all, what is a treasury bond? Okay, treasury bond is a savings account given to you by the federal government. So if we want to talk MMT terminology, when the government deficit spends surpluses into the private sector, or rather, it's called deficit on the federal level, but for the private sector, it's a surplus. Then the government offers the private sector a way to earn interest through different bonds, 10-year, 30-year, 1 year. So the 30-year bond does well when we have depression or recession, when the stock market crashes, when flight to safety is on, basically, when people get out of stocks or you can get out of risk assets in general, and they buy 30-year treasury bonds, the longer the duration, the more they will rally during such an event.
Well, and I think it's also important to point out is that there's I don't know if traditional is the right word, but there's a view that treasury bonds fund the government. The government sells treasury bonds in order to raise money for taxes.
Right.
Well, we go into much more detail about this in our previous MMT shows, and I recommend checking those out. But we do want to emphasize that treasury bonds are basically free money.
It's a free interest rate from the government.
Yeah.
And there's no constraint on the government's ability to pay back on those bonds. They don't need to sell more bonds or raise more taxes to do that. Literally, all they're doing is they're marking up numbers. Yes, I hear you screaming inflation, but again, please go back and listen to the MMT shows where we talk about that. So it's a safe haven because the only reason they wouldn't get paid is if the government made a political choice not to do it. There's no economic constraint on not paying them. So they're a super duper, they're like the most solid place to stick your money. And then going back to what you're saying about the risk-free rate, this is the risk-free rate, right?
Correct. The Treasury bond rate is a risk-free rate.
So, exactly. And just to go back to what you're saying about valuing corporate income, earnings, valuation, whatever it was, right. When you're saying we're discounting the risk-free rate, you're looking at the fact that, okay, if I wanted, what's the minimum amount of money I can make, or I should say, that's the maximum amount of money I can make with zero risk. Okay, it's this treasury bond. And let's say the treasury bond's paying 3%, just for the sake of argument. Is you're saying, okay, if I have 100% no risk at 3%, why would I ever take a risk at 3%? Right?
Exactly.
That's why you remove whatever the risk-free rate is to make that determination on that valuation. Right?
Correct.
Yeah. Okay.
Right. You want to evaluate the risk asset in terms of its outperformance of the risk-free options that are given to every idiot in your economy.
Right.
You know?
Right.
So that's basically that's how stocks are valued. That's what discounted cash flow analysis is all about. Stocks are always valued based on profitability expectations, the risk-free rate, and the risk profile of the particular business that we're in.
Mm-hmm.
Or the risk profile based on the management of a particular company. So, there's business risk, there's industry risk, and then there's macro risk. Mm-hmm. There's default, all these things. But with the treasury bond, you have none of these. You get at the moment you get 2.3% guaranteed for 30 years at no risk, at no default risk. Okay, and people will say, well, there's inflation. Yeah, but no default risk. Okay.
Mm-hmm.
And we get to the inflation because we have other assets in the portfolio to take care of that.
So far we've talked about two assets. The stocks, they go up in a boom, they go down in a depression. We've got the bonds that do the opposite, right?
Mm-hmm. Exactly.
I think, are we ready for asset number 3?
Mm-hmm. Asset number 3 is gold. Gold is very interesting because it is, if I'm not mistaken, I think gold is completely uncorrelated to the previous two assets. Or maybe there's a minor correlation, but it's enough of it does its own thing to where it does what you need it to do in the portfolio. So when does gold do well? Gold does well when real interest rates are low. People always say, well, gold does well when inflation is high. And that can be true, but only if real interest rates go down during that inflation. And what are real interest rates?
I was just about to ask.
Real interest rates is the current risk-free rate. Let's say that the rate on 30-year treasuries is I think is a pretty good one to look at, to always take into account for risk-free rate. You can also look at a 20-year or 10-year, but I think the 30 years is probably just fine to look at. So real interest rates is the nominal interest rate that you get paid on these bonds minus the expected inflation over that same period. So this shows you, right? If interest rates stay the same, but inflation shoots up, then gold will go up.
Wait. So I blacked out. I don't know if I blacked out or if it was just confusing. Can we go over that again? So we have. Tell me what a real interest rate is again.
Yeah, real interest rate is the nominal interest rate minus inflation expectations.
Okay, so if the nominal interest rate on my 30-year bond is 5%, just for an easy number, and we were to expect inflation to be 5% a year, Does that mean the real interest rate is 0 or it's some other calculation? It's 0. Okay. Yep.
That's exactly it. So this would be a scenario that you're describing where gold would be doing pretty well. And, if inflation goes up and rates stay like that, then gold will go up even more.
So that would be a case where the real interest rate is negative, right? Inflation's at 10%, but the nominal interest rate is 5%.
Which arguably
is what's happening right now, right?
we are in that kind of situation right now, arguably. Or what could also happen is nothing changes to inflation expectations, but nominal interest rates are reduced by Federal Reserve policy,
which has also happened very recently.
That also reduces real interest rates. So I will put it in the show notes if I find it. But there's been several people, one in particular that I found, that have run a correlation analysis of gold versus real interest rates. And it's the best correlation I've ever seen anyone make the case for. Another factor that drives gold is general economic uncertainty and war and
what's called potential political destabilization. How about that?
Political destabilization and any situation where the existing standards no longer work, or, for example, Russian people thought that they could use their bank account to buy things in other countries, but suddenly that's not the case anymore. So what if the entire global financial system breaks down? All countries pull out of the Bank of International Settlement system and these kinds of things, and a new monetary order has to be reestablished.
Well, gold will probably be doing really good while all that's figuring itself out. And
especially because gold would probably then be the de facto money for a little while, and the new monetary order will probably be based on current gold allocations around the world. So gold is kind of like the money, the universal money, if you will, that hovers above all other monies. Doesn't mean, like, we don't believe that gold makes for a good medium of exchange. We don't believe in the barter theory of money. We've talked about that in several shows now. But that's, of course, in an economy with a functioning system. But if everything breaks down, then there's still gold, and you can still weigh gold on your own, on your scale.
Well, is this a good time to jump into the fourth and final asset?
Yeah, the fourth and final asset, which is pretty boring, is cash. And Harry Browne recommends just 1-year treasury bills. What I do on Fidelity, I buy treasury bills at no fee. And I use a feature called auto roll, where at the end of the year, it automatically sells that treasury bill. You get the profits, and it invests the same in the same kind of treasury bill again. So you don't need to do anything; it just keeps rolling over.
And then you do that because it's the risk-free rate, where you're like, well, if I'm going to have this pile of cash sitting here, I might as well get whatever the heck the Federal Reserve is going to pay me on it, 3% or whatever it is.
And I think the treasury, the 1-year treasury bills are actually safer than cash. It's safer than cash on the mattress. There's no FDIC. There's no bank risk.
Oh yeah, so like if the bank goes out of business and they're like, well, yeah, you had more than $250,000 in your savings account. Sorry, there's none of that.
So that's the problem. If you have more than that, then you don't have FDIC protection. So that's where with treasury bills, you can have unlimited amounts in it, and you don't need FDIC insurance. You have it right from the federal government. They create the money that they pay you. So they create the money to pay the interest. They create the money to pay the principal. So it's as good as cash. Some people say. I would say it's actually better than cash. And
so what?
That's just the fourth asset, but also what this asset.
What's it do?
When you you earn the short-term interest rate, which, by the way, there are certain times when this rate goes quite high. Like, for example, I think in 2000 2006 or 2007, right before the 2008 crash, the short-term rate was somewhere around 6% or 6.5%, 7% or so. Like I said, in the early, 1980, it was 18% or so. So oftentimes, whenever the rates have gone this high, sooner or later, you're probably going to see some sort of recession. So your stocks will start suffering a little bit and those things. So then the cash will still earn a pretty good return. I mean, it's not a bad return to give you 6% on your cash. And also, when your other assets fall and decline, your stocks or your gold goes down, your cash is available for rebalancing and for buying low whenever those assets have gone down. And by the way, you have some cash that you can always fall back on when times get rough. When, let's say, you get laid off or you don't have business isn't very good right now, then you always have a good cash portion in this portfolio that can sort of help you pay your bills.
So would it be safe to say something like this, which is it's kind of the liquid that makes all the other pieces work?
Yeah.
Yeah.
It's the lifeblood of the economy.
Well, I mean, of the permanent portfolio, I'm speaking specifically of, because my initial reaction is to say, okay, here's this cash. If it's not making as much money, why not just throw it into split it between the other three? What's the unique function that it's doing that's helping with the balancing act?
Number one is that purely empirical analysis. It shows you that a portfolio, if you back test it for 50 years or so, the portfolio with the fourfold allocation, and one of them being cash, performs better than the threefold portfolio that you just proposed. Because otherwise, I mean, maybe it works better to put it all in these assets, but no, the cash allocation helps you in times when stocks come down, other assets come down, to rebuy at low levels with a lot of the cash that you have sitting in the portfolio.
Well, and then, like you said, also there's the short-term bonds where, there is a chance that, the short-term jumps and you're like, wow, I just got 5% for nothing.
Yes.
Yeah.
Yes. So this is a factor that will absolutely occur from time to time in the economy. You'll have high interest rates, and you would be losing out in those moments. You'd be losing on the stocks that you've put your money in instead of cash. You'd be losing on the bonds when they come down, or on the gold when they come down. That you wouldn't have lost had you had a portion in cash. And I mean, also, by the way, like again, if you don't have a cash position in your portfolio, you don't have a rainy day fund for yourself.
Right.
You rely on all those three assets always doing good, and they might not always. During a recession, there's actually times when the other three assets will come down: gold, bonds, and stocks, and that's when it helps to have a little bit of a cash buffer.
Well, and then if we're talking about the balancing act, if you do go past one of those bands, you go, okay, now's the time to take that cash and buy the other stuff because they're low.
Exactly.
Yeah.
Exactly.
So when you first told me this idea, I found it fascinating for the reason that you brought up already, which is there's this auto balancing act that forces you to make the good decision, which is actually counterintuitive. Right?
Exactly.
And so we have these economic forces at play, and we talked about the different economic forces for each one of these four, cash being kind of boring one. But whatever the economy's doing, if this one's, even if, like you said, all these other three go down, this one still remains neutral. The cash still remains neutral, so you still have the balancing act going where, okay, this one went down, flush the money over here. Okay, this one went up, flush the money over there. And why it's designed where when all this flushing happens, you're still flushing up.
Absolutely,
right?
Absolutely.
Yeah.
The net gain is positive, and over time, if you back test this portfolio over 50 years or so, people have come up with an average annual rate of something like 9% 9.5, 9%,
which is pretty good for a secure investment.
It's very good for the incredible safety, the stability, the stable growth that you get with this portfolio,
Mm-hmm.
the psychological calm that you get with this portfolio.